Hi, this is Pat with Energy Solution Partners sharing with you our energy market view on Saturday, December 21st. A reminder there is a risk of loss when trading commodity futures and options. I'm going to spend the commentary today talking just about the gasoline market. Seeing a lot of things setting up here that I think is worth pointing out, and a lot of seasonality and seasonal trends that come into play here. Well, the majority of these items are technical in nature. It's pretty hard to ignore what the market has done here over the last several years in the current window that we're in. This first slide just shows what the gasoline market has done over the last 3 years. You can see the seasonality of the March futures to climb in the window that we're currently in. Back in November, December, the 2014 March contract is traded very similar to what it did in 2012, 2013, and then you can see what 2012 and 13 did from this point going forward, and pretty impressive rally. And this is a seasonal tendency, so I think we're in a window here that we need to be looking at if you're looking for any gasoline coverage at all. Just another snapshot of that same chart, but I wanted to box this in. This is a study that's done by More Research, and according to their study, the March futures contract has gone up 14 out of the last 15 years in the shaded area going through January 30th. So pretty hard to ignore that. 14 out of 15 years is pretty consistent. As we look at what the market has done here over the recent days, on a chart, it's also looking like we're breaking out here a little bit. The rally here over the last few days has been pretty impressive. As we broke above the previous high going back here to November, I guess now I'm looking, our focus is coming into play here to target this 200-day moving average, which is a purple line. I think that's our next point of resistance here. And maybe we'll pull back a little from that area. Generally these key moving average lines do create some resistance for us, and maybe give us some buying opportunity if we get any pullback at all from there. But once we break through there, I'm looking that we're going to focus back to the gap that was left in the chart, going back to August of last year. And when we see a gap, and what I mean by a gap is when we close on August 30th at 298.44, and then when we start trading in September, we gap lower, which is this big open space right in here on the chart. And that is the seasonal difference in the gas contract as we move into fall and away from the winter spec product. But now we left this big gap, and that's always a target to come back and fill that gap. Again, technical in nature, but the chartists do not like to see these gaps in there, and generally we come back and fill that. So I'm saying our target here is to at least fill this gap in at 298.44, and you can see today we're trading at 278. So there's another 20 cents to go. Although if we do look into the April-May futures months, they are already trading in the 294 range, which makes a lot of that up. But I think we'll probably take a good run at that in the February and March contract, which is also trading in this 278 range. So it looks like a good possibility. We've got at least 20 cents to go to higher to fill this gap in. So paying attention to that, again, all technical in nature, not completely understanding why the chartists look at this type of technical trend to focus on, but it does seem to come into play year after year. Here's a look at another gasoline chart. This one is the weekly continuous chart, and as we look at these charts, the longer the period, the more meaning the chart has as far as the technical view. And so a weekly chart has more meaning, technical in nature, than what a daily chart would have. But a few things I want to point out on this chart. First of all, going back to 2012, where the market had peaked, this happened in late March into early April. 2013, we peaked in late March. And so as we look at where we're at here in December, I think time-wise, we still have a couple months to run this market higher. Another thing I wanted to point out on the bottom of the chart here is a stochastic study that I've made mention in the past. And this is a pretty good study indicating an overbought or oversold position by the technical traders. And you can see in November the stochastics bottomed out down here in a way oversold position. And since that time frame, that did leave us ripe for those oversold positions to buy back and move this market higher, and that's exactly what happened as we anticipated. Looking back to 2012, where the stochastics went, we moved way into a way overbought position before the market rolled over, and the same thing happened in 2013. We moved into a way overbought position, and then the market rolled over from there. Where we sit today, we're really in a neutral position here. We're neither overbought nor oversold, so I would anticipate that we continue to move the stochastics in a higher position, and if we do move into the overbought territory like we have in 2012, 2013, that'll be our sign that we'll want to start getting defensive and either taking some profits at that point or buying some downside protection to protect anything. But between now and then, I think there's a good chance that this market can continue to rally higher. I guess I want to throw one chart in just to look at some fundamentals rather than a complete technical picture. But this one is our gasoline inventories, where we're at. We're still right in the range where we've been the last several years. They're about a 5 million barrel range for this time of year. So inventories, I would say, are in a normal level. You can see last year in 2012, the inventories continued to climb through the end of the year. But even though those inventories climb, we also watch the market climb. So fundamentally, I think we're probably neutral as far as our inventory levels here. But I think the technical trade is in control here, and we can't fight these seasonal trends that are in place. So with that, I guess just one comment on diesel. If the gas market goes up like we're expecting, it will drag the diesel market higher with it. So anybody looking at getting in the diesel positions, I think can ride the coattails of this gas thing. Otherwise, as you can tell, we're liking the gas market. We're looking at anything fixed price contracts, futures positions, option positions, option spreads. We can play it a number of different ways. Get into this market, ride it higher, and then we'll be looking a little later on here if we do run higher, either taking our profits on it or buying some downside protection. So if you'd like to discuss any of these strategies at all, we'd love to hear from you. Feel free to give us a call, and thank you for listening. I'd like to wish everybody a very Merry Christmas.